Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're doing a breakdown of some brand new ETF funds. Now, these guys have been out here since pretty much February or March of 2026. So we wanted to do a head-to-head competition between the newbies to see which one are actually doing well, which one should we pay attention to, or maybe we should just ignore them both and let them sit. Today we're going to go against EDGX, which is the Global X, versus the ROCY from JPMorgan. Which one's better for retirement? We're going to talk income growth, total returns, and taxes. So let's sit back, relax, pull up the mug, and have a sip while we go through the entire process. So let's look at the analysis parameters that we're going to use. So the comparison window, what we're doing so we can compare apples and apples, we're going to start March 18th of 2026 to July 15th of 2026. The baseline, we're going to share the starting date based on ROCY's inception, which was March 18th. So you can see that EGDX was just a month earlier. So the data status represents a cover of approximately 4 months and finds the preliminary and not effective full market cycles. So that's a big issue that we have there. The distributions calculations are all going to be taken into consideration with using reinvestment. Now, before we dig any deeper, I got to say this presentation is for educational purposes only. It's not to be constituted as financial advice. It's not recommended is to be made, buy or sell or hold of any ETFs, and past performance does not account for future performance. Hey, before we do, I got to do a shout out for everyone who has not heard about this yet, but what we do here is we don't take advertisements. We don't do anything with that. We do is what this supports the channel. We have 2 coffee mugs now. We have a 11 ouncer and now the big mug 11 ounce, $8.99, $11.99. All the proceeds go to keep the channel rolling, keep everything that we do in order. So it's so simple to order. Go down below, you'll get a link in the description. You can click on that, or you can hit the QR code. It'll take you right to the shop that has everything that we offer with the Retirement Made Easy logo and Doug the Retirement Guy. So thank you if you've bought one. If you haven't, here's a great time to support the channel. We appreciate it. Now, real quick, I know you don't like ads, but here's a big one. We just introduced a 40-ounce travel mug that fits great in the cars. I started traveling saying, boy, I need something instead of my ceramic mug. I need something I can travel with. It keeps your drinks cold. It keeps a strong handle, and it's only $27.99 plus that shipping, which we don't make money on. But basically, we're doing this to support the channel. And if you haven't, here's a great opportunity to get a phenomenal mug along with it. So let's start off with EGDX, the Income Engine Overview. This one comes from Global X. It's the US 500 Index Edge ETF. It's engineered to provide a broad US large cap market exposure combined with high frequency cash flow generated through dynamic option premiums. Now, what do they use? They use approximately 500 of large U.S. companies. It utilizes a low-cost ETF base with exposure to VOO, SPYM, and BKLC. Now, of course, those are dialed right into the S&P 500. Now, designed to track the general direction of the U.S. equity market. Now, the option mechanism, it sells call options against a portion of its underlying equity exposure. Okay, it's a dynamic adjustment. The options are covered to actively manage based on market conditions. So what basically I'm going to tell you is this. It comes down to is if the market is having a good rally and it's growing, they're going to reduce the amount that they do options on to gather that growth. And then when the market has volatility and things slow down, they're going to cover more of it to generate more income. So never at one time is the entire fund completely covered. And that is going to see where you're going to see true growth of a fund and income from a fund. So it's a unique way that they've done it. The payout structure is targeted at a 9% target. And we always use target, and I'll tell you why the word target's in there, is because we don't know. We don't have a full year looking at this, but what the plan is and what they're looking at, Global X is targeting right around that 9% is what they forecast out. Now, the unique thing with EDGX is that weekly frequency. They are paying out weekly their distributions. So their premiums on that weekly basis that they're trying for that consistent income potential, and it's focused on cash flow predictability for retirement planning. So what the advantage that we have here is this one acts to you like a paycheck that you probably gave up when you went into retirement. So this one gives you that ability to get that Friday paycheck. So let's pop the hood on EDGX. And we look at this, assets under management, $5 million. Now, this has been out there, like I said, since February 17th of 2026. So assets under management are personally a little light at 5.09 million. It has about 190,000 shares outstanding. It's paid 93 cents in distribution so far for 3.48%. Now remember, this is just from February. And the price has been bouncing around between that $26 to $27 range. When we look at the growth side of it, and we're going to cover all these in more depth and do a comparison, you can see the growth has been 6.44% year to date. So it's definitely gotten some growth. So current yield, capital appreciation, and the volatility really has been low. Now we take a look at ROCY. Okay. This fund came out, and this one has a data science driven portfolio. The portfolio is concentrated about 112 different positions. It is tech heavy. Okay, approximately 38% of the portfolio is NVIDIA, Apple, Microsoft, Alphabet, Amazon, the tech style companies. The structure of the engine is they use covered call spreads to generate premiums. The strategy sells calls while simultaneously buying higher strike price. This approach seeks to collect current income while retaining meaningful upside participation in bull markets. So again, putting this in my layman's terms, Doug's versions, what they're doing is they're selling a call option and they're looking at, okay, who's got a higher call? Who's the next level up on the ladder of call options and strike prices? So what they're doing is, okay, we're going to sell this at, I'm making a number up. I know everyone leaves comments, but I'm making this up. We're going to say, we're going to sell this at $50. And they're looking at, oh, here's one we can buy for $60. And they're going to bring that up. Now they have another one that's going to sell at $60. And that allows them to keep moving forward in strong markets and strong rallies. So it's a unique way of doing this, is that they're constantly buying and selling call options to generate that income. When we pop underneath the hood, now this JPMorgan has definitely had a lot more excitement, because the same exact strategy is what grew JPI and JPQ, its sister, I call them brothers and sisters, they're other forms. And what's happened is the excitement of this is giving you assets of $270 million. Big difference between the two. So this one was out to March 18th. So 270 in assets, expense ratio 35.35. And then they have 4.83 million shares outstanding. So you can see we have two funds, totally operating in totally different acceptance of the markets. Now the distributions, they've paid $1.25, and the yield right now is 2.28%, and they pay out monthly. Now this fund also has been paying at $54 to $50, almost $55. So there's a lot more value into the fund as well. So let's sit down and really take a quick rundown of these two so we can understand each other head to head. Global X uses what we call a passive and index core exposure. It's the broad exposure to the S&P 500 using VOO, BKLC, and SPYIM. Now they write partial writing calls on those. As I explained earlier, it's adjustable to what's happening in the marketplace, normally from that 25 to 75% range. Now the transparency, it's a simpler structure. The index like behavior reduces that stock picking risk. So you don't have to worry about them saying, oh, NVIDIA is going to be the good one. No, AMD is the better one. Oh, Amazon's going to be the better one. You don't have that risk because they're buying an index flow. And the cash flow is weekly distributions. Going up against JPMorgan is a data science driven portfolio. Okay, so really the computers are picking with the data that they give the 112 exposures, and they're using heavily weighted in the mega cap tech. So the call option spreads that they use, as I told earlier, they're selling and buying strike prices. It's a very efficient way of doing it. It's very flexible. The structure and the tax consequences will mandate for deferral, and it's a monthly distributions. So you can see quickly again, cash flow, weekly versus monthly. That's why I wanted to pick these two. Transparency versus efficiency. Call option writing, partial versus call option spreads across the board. So some very, very differences between these two programs. Now, I put a slight advantage to ROCY because of its sophisticated tax design. Now, the balance of EGX's superior transparency and the simpler, broader market access, we're not calling one or better than the other. I just put a little advantage, and it goes into the really into taxes, which we'll talk about. So let's take a look at the income, because this is what most people worry about, is the income side of it. And the income side, that weekly payer, is going to boost the yield. It's doing a little bit better boost so far with the 3.12% yield. Now, of course, we don't always chase yield, and they're shooting for that 9.6% yield so far. Their last distribution was only 4 cents. Total distribution 76 cents. JPMorgan, though, $1.25 cash inlay, 7.7%. Now remember that yield is just a mathematical number because Global X is only $25. JPMorgan is a $50 fund. You can see what the difference comes into. You're going to get more cash from JPMorgan than you do Global X. Now there is a 2.5% yield, and they're really targeting that between, that they're going to say 7.7% is their annualized yield as we sit, but they're trying to target between 7.4 and 11.9. So that's a big gap that they're shooting for. It's a giant target, while Global X has more of that 9% range that they're shooting for. So you can see in the bar chart, the edge is going to go to EDGX. Now the growth. Now this is something that's been interesting too. ROCY has had a stronger growth over the same exact period we're talking about, okay, versus what EDGX has. The ROCY advantage is the benefit from that attractive selection of high-tech weighted stocks is showing that it's picking up that extra, basically 0.2% gain, or as they call it, a gap into the system. While EDGX has the stability of that index, that 500 index, is actually been doing a very well performance between the two. So, you got to give it to ROCY for that 0.2, but honestly, I think they're both running about equal to each other for the performance across the board. Now, total returns. As you know, I always follow the total returns because it tells me more about a fund than anything else. And EDGX has got a total return right now about 13%, while ROCY has a total return about 12.6%. So where's the difference coming into? Well, it really dials into is just basically the growth and income. Okay, and it sounds funny when I say growth and income. You got a growth difference of about 0.2. You got a income difference of about a 0.6. Okay, this is where you're looking for a 0.4. This is what I'm saying. It's EGDX is losing just a little bit in the growth, but they're picking it up on the income percentages. So these two are very, very close to each other again. And I did this in a hypothetical. If you had $10,000 invested in both, where would you be at right now? And you're basically, again, you're about 40, actually about $37 difference between the two. So very, very close across the board. Now the tax treatments on these two. We talked earlier, JPMorgan's going to have that better tax program. Well, what are they doing differently? Well, both of them are using return of capital. So July 8th, 13th, the estimate ROC was 99.56. For the whole year, they're saying it's 82.7. Now remember, these numbers do not mean anything until you get that 1099 dividend form at the end of the year, because you can see these guys can make these changes across the board as you can. Now, JP Morgan came in at 89.85% with the ROC. Same thing. You got to wait for that 1099 form. So understanding, basically, if you're not familiar with it, I have many videos on ROC. And that is basically, you're just reducing your cost, kicking the tax can down the road of these two. This is a very, very common piece. It's a very strong piece. It's a very good piece for retirement as well. If you hold these things, you're probably never going to zero yourself out. It takes a long time to do that. So overall, where do we go? I put the advantages, ROC tax advantages for taxable accounts. If you're in an IRA or a Roth, it's no difference. But the little bit of advantage I put on ROCY, and the reason for I do it is JP Morgan has had a better track history of dealing with their ROC situation. Okay? So you're going to get more money in a JP Morgan than you do in a Global X overall once you get done with the ROCs. Again, we don't know this until we get to the 1099 dividend form to be accurate, but there are so minute differences between the two. Now, here's where we get into the fund structure, and I wanted to bring this up again. This is a critical point of this. The Global X, it's been out there longer than the JP Morgan. Now, I guarantee you, JP Morgan's got a lot of excitement. People from JPI and JPQ, all of that. Once they found out that the tax problem was fixed in those funds, people were switching very comfortably, very aggressively. But this is the problem I have between the funds. Assets under total management that you've been going here now, basically about 5 to 6 months. You're only at $5.1 million. Has it been growing? Yes. Has it been growing strong enough? Definitely not. Even with their promotion of 0% net fee, which will go to 0.50, half a percentage point, on March 1st, they've gotten some excitement, but nothing major to keep this thing going. And why I get nervous about this? If a fund like this does not have $50 million, you are still in the danger zone. It costs money for these companies to do this. It costs money to do how they trade and so on. They got to get that thing to 50 million. So that's a concern for me. It becomes that liquidity issue. So, they need more income or more assets into it. JP Morgan, though, with 271, has had a strong early adoption. They use straight out the lower expense ratio, which you're going to see is 0.35. This is their lower fees across the board. Their trade liquidity is extremely high. So it's a safer bet. ROCY is actually safer than what you're getting into Global X. I'm just got to be honest with people that it's because of the assets under management. ROC holds that structural advantage due to that larger asset basis and that superior liquidity and that long-term management fee of being much lower. So I'm not falling into the 0% up front because that's only a short term. It's a 0.5% versus 0.35. So overall, I'm saying JP Morgan to me looks like a better option across the board. So determining which one best fits your retirement. If you are in a IRA or a tax deferred program, EDGE will definitely work. ROCY is a taxable account, is its best fit. Okay. Not saying it's not won't work in an IRA, but it really fits well. And this is kind of put what the company says is they did this for a reason. They have their JPI, JPQ for the IRAs. This is what they designed for taxable accounts. Income maximization, you got to go with EDGE. If you're just purely looking at yield, which I don't suggest, if you're looking at yield, it's going to be the winner at that 9.6, generating more income. If you like that weekly paycheck, EDGE has got it again. If you like the more exposure to the full S&P 500 broad market, I personally, these are things I'm putting on here that I like, is definitely an advantage. And the total return EDGE went to EDGX. Now, ROCY has that tax efficiency. It's designed specifically for tax deferring through the ROC program. Even though I talked both had ROC, they have it dialed in more effectively. It's the higher liquidity that really pushes me more towards ROCY versus EDGX. It's an active managed. They do use that high tech. You may be sitting here saying, I don't need high tech. I got my NASDAQ 100s. I don't need this. Okay, then you want different exposure. And there's reason, and then I'm not going to argue with you. There's reasons why EGX is. And then you have a lower long-term handling fee with ROCY. So it's a tough call, guys. It's a very, very tough call between these two. I still put, you got to keep an eye on EGX's total asset value. Once that thing gets to 50, I'm probably okay across the board on those funds. So my final scoreboard, my verdict onto it, it's EGX is really a pure income specialist. They are designing this thing to give you that yield and that, like I said, 9.6% with a 13% total return. And the positive to it is that weekly cash flow. ROCY though, I have to put it, guys, this is the complete retirement fund. This is the fund that I have more confidence in, more value in, is because it's using the tax deferral. If you're using it in a brokerage account, and I gotta completely say that $271 million in assets already, I just think it's secured itself, it's secured its base, it's locked it in. It's having some good growth across the board. My pendulum goes to ROCY across the board. Now, if you come back and argue with me and say EGX is your choice, I understand the numbers. I understand those numbers, and I understand the weekly cash flow. But I can't support that until we get over that $50 million hump. I hate to say that. It's really the key factor to me. Let me know what you thought, what your feelings are. Do you own EDGE? Put a comment down below. I'd love to see how many people own the EDGX and how many people are into ROCY. See how it's banking out and see how you made it and why you made your choices. I'd love to hear from you guys. Leave a comment down below for sure. Let me know if you're on the same page as me or if we're different. So I always got to tell you guys, do also monitoring the checklist and the conclusion. You got to look at that NAV stability, which is what's really coming this video is about, is that NAV stability. The distribution consistency and your upside capturing, which they both do a great job on, and the market decline behavior. How is it happening? So take a look at that. Let me know in the comments below. And also, don't forget about our 40-ounce new mug. They are in production now. Order them now. As soon as they arrive, we'll get them out to you. We're just trying to see if we get any pre-orders to it, but we already committed to some, hopefully enough. But let me know, and don't be afraid. Use the QR code and the link below.